Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Hi, Jim, and here we are, a pleasant Friday in the weather and a pleasant Friday in the market. So there we are.
Yeah, but Bob, I saw in the long-range forecast for next Friday, snow for Vancouver. Oh, my God. Plus a transit strike. Isn't that pleasant?
I've got advice for you. When there's a snow alert for Vancouver, you stay indoors and drink lots of fluids.
Yes, the fluids of your choice.
Yes. Mm-hmm.
Bob, we like to open up the show with questions from our listeners. Our first question is from Mr. Anon. He says, it seems like the GDX is becoming oversold. What kind of reaction should we have to that?
Yeah, the gold stocks, my gosh, it was November 1st a year ago when we put on the accumulate, like to buy them. And then the next low was the middle of the month, so there was a couple of weeks to get positioned. And then there was a terrific rally right out to July when, guess what, things became overbought. Our special technicals were getting overbought. So we just advised then to take some money off the table, and guessing that again perhaps fall and winter may be down trading, and so the gold stocks have sold off. But I wouldn't say that the GDX or the GDXJ are oversold yet. I just did check them, and they can get more oversold than they are now. And also, the stock markets have been quite positive. Also, like base metals were okay, and so and crude oil is staying positive. So there's a number of cross currents in here at a time when you can have seasonal lows. So we're still thinking that you could have a seasonal low for crude oil into January, and that's not going to be friendly to the overall markets and not to the gold. So yes, the GDX is getting a little oversold, but not enough yet to say that it's a buying opportunity. And then also we had a question about the 10-year treasuries. And we've seen the last of the 1.5% rate on the 10-year treasury. And yeah, I think interest rates are generally going to go up. The bubble in bonds has been enormous, and it's not going to go up because of or interest rates are not going to go up because of return of inflation. It's because there's so many junk bonds and about to be junk bonds issued that the problem will be servicing debt. So a general avoidance of longer maturities could hold the longer rates and treasuries up. So two phases to that question. The guy's obviously familiar with markets.
Mm-hmm. Now we have our friend Willem Grooters from the Netherlands with some questions, and I think he's basically asking us if the holiday is over for long-term treasuries, and have you looked at the commitment of traders lately?
Yeah, Ross, my colleague, is very good at keeping track of the commitment of traders figures, and indeed I think he's the only one that does technical analysis of the commitment of traders numbers. And when you look at it that way, you get some very good divergences and indications on potential changes. So, with the last question, longer rates are trending higher, and certainly on the lower grade stuff can trend a whole lot higher. Whereas it's ironical because short rates like the T-bill rate could be going down. So.
And Willem also asks us, when I look at the transports relative to the Dow Industrials, that doesn't give a clear signal. The transports have rallied recently, but didn't, like the Dow Jones, make new highs. Would that suggest the Dow Theory gave a non-confirmation signal, and will that spell trouble in the months ahead?
Yeah, well, that's a good question. I looked at that yesterday when writing, and gosh, we don't often use the Dow Theory, but we did in 2015 when it was stretched out non-confirmation for so long. It in itself became a warning, and then there was a pretty good sell-off into early 2016. But this one, it's not as distinctive, and I just didn't feel like adding it. But there is a negative divergence from the transports. It's not confirming new highs. So, yes, it is an issue, and for all of us, it's well worth watching.
Are the transports kind of the canary in the coal mine? What happens to them could be an early indicator of what's going to happen to the market in general? Yeah,
it can be. By gosh, it's the old guy by the name of Hamilton in the early 1900s. He came out with the Dow Theory, and he had noticed that the interplay between the Dow Industrials and the Dow, I think at one time they're called the rails rather than transports. But at any rate, it's a guide of many for the major directions on markets. And, of course, what one wants to be really interested in is the potential for change. This is where it really happens, is always looking for change. So this is where our work in taking from the historical point of view and having studied all of the great bubbles in history, they give you, there's a methodical pattern to a climax and then to the contraction, and then you fill in the details in between with technical work. Hey, it's been a very good guide for us. The other thing is that financial history provides you with which I call a due diligence on every grand scheme ever floated by promoters, whether it's individual promoters in stocks or economic promoters with their theories that they can manage the economy through the central bank. And let's just review it again, which I love doing, is that when the Federal Reserve was formed in the early 1900s, the street knew, policymakers knew that if you had a hit to the financial markets, more than likely a recession would follow. So then they come up with this theory of a deus ex machina, in which case it turned out to be the central bank, that with that you could have the bank as a lender of last resort, and it would prevent the financial setbacks that precede recessions. But they never seem to understand that in an irresistible bull market, everybody gets in trouble or gets leveraged. And it's not just one single bank or lending agency that is the problem. It's everybody. And then the power shifts from the central bankers to margin clerks. And let's look at their basic job descriptions. A margin clerk is to make sure the accounts are in line, and the job description these days with reckless central banking is their objective is to get the accounts out of line and highly speculated. So even not just reckless central banking, even the basic theory of central banking being able to manage the economy is in itself a wild speculation. So let's just see how well this theory of being lender of last resort and preventing recessions has worked. There's been 18 recessions since the Fed opened its door for business in January 1914. So anybody in physics would say you take a look at the theory and you take a look at the result, and it doesn't work. Now, it is the theory of central banking, managing the economy and preventing disasters, is very appealing. It's very attractive. But when applied, and you take a look at the history, it does not work. And yet, the state, well, the only reason why it exists is because it enhances the power and revenues of the state. And now it's become so blatant that the Federal Reserve and the Bank of Canada, they now only exist to finance, or let's put it this way, to provide unlimited financing for yet another experiment in unlimited government. The whole thing is bizarre, and I think in ending action. So we'll see what happens.
Right. We all remember Einstein's definition of insanity was doing the same thing over and over again, expecting different results.
You got it there.
We'll have some more interesting topics when Bob Hoye returns.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, technology stocks are enjoying their best year since 2009. I seem to recall what happened back in 2009. Is this another warning sign?
Yeah, it is. And it's been incredible because you've had, like this S&P making new highs because serious investors around the world have been buying the big cap U.S. stocks. But the New York Stock Exchange Composite Index, which is most everything, it has not been making new highs, never exceeded the high in January 2018. So, but within this, you've had really hot groups. You've had a couple of years ago now, the pot stocks, and they are a disaster recently. And then IBD this was Home Builders Index, to about 6 weeks ago to spectacular technical excesses, and then now a certain group of technical stocks. So there is a very strong will to speculate, and you also have, when you get markets like this, you'll have more seasoned players who will trade the short side looking for the break, but if you're too early, and then you have to cover. So the shorter's power on a concluding market, but at least one thing about short sellers is when then the market really does roll over and decline, you do have a bid there from the short sellers who then at some point cover. And as the very colorful trader in New York in the 1850s and 1860s, Daniel Drew, he was a famous bear raider, and he's the one who's attributed that he said, "He that sells what isn't his'n must ultimately deliver or go to prison." And that's the point with short selling. You sell stock you don't own. You owe the market the stock. So then there's for every short there's an automatic built-in bid. And but in a bear market, officialdom really hates short sellers, and yet they're essential to the market. So we'll see what happens with this market here. It's been unless you're very selective, it's always dangerous to short the market until you get the actual reversal. Now, on a potential reversal in the stock market, credit markets have deteriorated more in the last couple of weeks. Like the credit spreads have now widened to new highs. So we've had now 3 breakouts to widening on credit spreads. Not good. And then the other one that was getting a whole lot of noise was the yield curve, which is the difference between short rates and long rates. And through the summer, certain portions of the curve were inverted, whereby short rates were higher than longer rates. And so that's taken as a sign. And then what's happened here now is that the curve is no longer inverted, it's changed. So the street is saying, oh, well, the warning's off. But they don't understand it's a single event, bang, you get the inversion. And our charts on the yield curve go back to I think it's 1857. And so it covers a lot of bull and bear markets, including a number of bubbles. And the instruction from history is that you get the curve fully inverted, you get a contraction, or we can call it a recession. So that's our stance, is that the curve did what it did and is reversing. Now, here's another positive that came into the market, Jim, is that when you get a steepening yield curve, it's considered good for for ordinary banking, commercial banking, and that sort of stuff. And it is. So you've had a nice secondary rally here for the bank stocks. But then as the curve steepening continues, it indicates a contraction, and those are very unfriendly for banks. So you're at an important forces developing here within the banking and credit market side. So where most people watch the stock market, and certainly the press, the stock market gets most of the press, but underneath it, you got credit spreads and the yield curve, and they are now negative. And when they turn negative, it can last for a long time. Well, it's like when they're positive, and they were positive and through into the middle of the summer, and then they began to kind of back away from party time and began to give their warning, of which the last couple of weeks they've deteriorated quite a bit. So we have a high regard for what's going on in the credit markets.
Another headline that you pulled up, Bob, China's small banks are wobbly. How wobbly are they?
Well, here's the other problem, is that the issues when you've been in party land, not everything changes at the same time. And so earlier in the year, you had sudden losses of liquidity in Argentina and in Turkey. And then a little later on, it was in India and China, and those are very large markets. But we call them outlying markets. It's not the main market. The main market is New York and almost as main as London. And in the past, when the problems appear in outlying exchanges and then work their way to the financial capital. And then also within this, your smaller and perhaps less well-managed banks, you can find problems there. And this is what they're finding now in China. And the thing to be understood is that the central banks, the debt issue is so great that while a central bank can throw credit into a credit contraction, when the market is really contracting, nothing happens. It just sort of disappears. And most people don't understand that in the fall of 1929, during that crash, the New York Fed bought bonds out of the market, injected cash, and it exceeded its lending authority by a factor of 6 times. So you can say that in 1929, the Fed was very easy, but it didn't work. So here we are. You can't say it's 1929, but you have had a fabulous speculation, and things are beginning to unwind.
We'll have more with Bob Hoye when we return.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, junk loan market signals are telling us it's the end of the buyout binge. Can you tell us about that?
Oh, I love a headline in the financial markets that mentions binge, and this is what it's been on. When money is easy and available, it flows into speculative and reckless hands, and everybody's got money for deals, and then it begins to change, and that's what's going with this one. They say that the junk bond market, you've had junk bond prices declining now for 3 or 4 months. Nothing too dramatic, but it's also part of the spread widening, which then begins to shut things down. So one of the things that von Mises and the Austrians did get right, and it's a simple observation, is that at the end of a boom, bankers don't have to call loans to force the contraction. All they have to do is get a bit concerned and stop making them. And here's what you have, a couple of steps removed is the junk bond market is a form of banking. It's getting money into the hands of speculators, and that one is slowly having the window closed. So, as you say, thanks for bringing up the one about binge in the financial markets. I always love it because that's a signal of ending action when they're talking about binges. So.
And you've also found another headline. Vladimir Putin says the U.S. dollar will collapse soon. What does he know we don't know?
I think he just kicked that one out. But, there's a widely followed gold bug in the States, and when you're on a strong gold market, and if gold's rallied something like 20%, that's when they all crash. Well, we found kind of a rule here, Jim, and you get a gold rally by 10%, the gold bugs will come out and say the gold's going to go to 5,000. Then if you get a rally and amounts to 20%, then they up the target for $10,000. And of course, this requires the U.S. dollar going all to hell. And, but this guy, he always seems to work in that one time he worked for the CIA or got close to the CIA. But here you have Vladimir Putin, a former KGB guy, and he's picking up on the story that I guess circulates within the CIA about U.S. dollar is going to go to 0 and gold's going to go to 10,000. And that gold bug, I bet you on the next strong rally in gold, they will crank out a forecast of 10,000 and the dollar going to 0. So Putin getting in on that, I don't know. I think it's unwise of any political leader to comment on financial markets.
Bob, thank you so much for chatting with us.
Well, there we are, Jim. We've got the Friday piece done and look forward to talking to you next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, like several of our people who listen to us did today, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.